Good evening, everybody, and welcome to another live stream by the Option School. This is your friend Pradeep Singla, and in this channel, we talk about option trading strategies, and option trading adjustments. Now, adjustment is the key for any option trade. Even if you're wrong, this is the title today. So, we have seen so many times if you do a proper adjustment, uh, any trade can be sailed through. It may not become profitable, but at least the loss can be taken care of. So once you have that kind of a confidence that okay, my trade is not going to give me a loss, it's always a great trade, right? So what happens? Why, although we all understand this, why we are not able to do that, and what are the calculations we need to do so that every time we are able to get out of a trade, even when we are wrong. So getting out of a trade even when your direction has gone wrong is something which can be achieved if you do little bit of planning just before we do the trade. So I was again saying we can be profitable even if you are wrong. This is possible only in options. If you talk about cash markets where purchase the stock and it has gone down, you really can't do anything, right? But only in options trading, even if you're bearish and market has gone bullish, you can still be profitable. If you were bullish and market has gone bearish, then also you can be profitable. Only thing is we need to know how to adjust the trade. I will show you a very simple example, and we will see why we are not able to follow these things, because ultimately we make our trades very very complex. And with today's discussion, I'm throwing you an idea. All of you are expert traders, throwing you an idea of trading in a very simple way, wherein we are just simply taking up the trade, and based on whatever is happening to the market, we are adjusting. And there is a very very slim chance that okay, this trade can go ever wrong. But yes, all your views are always welcome if you have any other views on what I am going to suggest. So there are four possible trades in options trading, as all of us know: buying of a call, selling of a call, and buying of a put, or selling of a put. These are the four possible trades. Now, these we can say uh, any trade ultimately is one out of these four. Even if you are doing a three leg trade, a four leg trade, ultimately, if you check the health of the trade uh, through its Greeks, you will come to know that okay, the ultimate trade is either a call buy, either a call sell, depending upon what is the theta, depending upon what is the delta, or is a put sell or put buy. So uh, even multiple leg trades ultimately converge into one of these categories. Or we are saying okay, let us talk about simple plain trades, that okay, there is something known as call buying, there is something known as call selling, and something known as put buying, something known as put selling. And we are going to do this based on whatever we feel. If we feel that okay, market is going to go up, so best is okay, let me buy a call. Now, why do we not buy a call? Can anybody answer me? Why we do not buy a call? What is the risk when you buy a call? The risk is whatever money you have given to buy a call, uh, that can be taken away from us, right? If you are purchasing a call, let us say by paying 50 rupees, and I'm talking about Nifty, so 50 into 50, 2500 rupees can be lost in case market do not go in my direction. In my direction means when I'm buying a call, obviously I'm looking the market to go bullish only, right? Theta decay is perfect. Theta loss, Mr. MG says, Mr. Rajiv, yes, definitely. So that is the worry. So let us see how we can take care of these things. And for doing these things, do we need to do initial planning, which is something like money management? How can we do that? Let us check it out with an example, and what to do whenever assumptions go wrong. So here we are assuming that okay, if market is bullish, I will buy a call. What will happen if market becomes bearish? And if market is bearish, I will buy a put. And what will happen if market becomes bullish? Is it necessary to lose money in those cases when my assumptions are going wrong, right? Let us see with one simple example. All of you who are new to the channel, I will request you, please go ahead and click on the subscribe button. When you're doing that, please click on the bell icon also, so that you get a notification whenever we are doing a live stream. We are doing live streams 8:30 a.m. in the morning as a pre-market report. and we are doing a live stream on different topics of options trading at 9 p.m. in the evening every day, Monday to Friday. And all of you who are already part of our family, you know which button to click, right? So somebody is asking again, can I trade iron condor lifetime? Definitely, you can do that. You can definitely do that. Iron condor is one of the best strategies. Only thing is, yes, you need to know how to adjust the trade, right? Okay. Now let us say, suppose I am a trader. I have made an assumption that okay, market will go down. I'm not here trying to say that market will go down or up. I'm just to take an example that what can be a simplest trade and what can be the simple adjustment if my assumptions are going wrong. So here I am assuming that okay, market will go down. I do not know what has happened on that Jackson symposium, or I think they have said that okay, they will be doing some tapering by this year end. So I'm not taking clues from that. I'm just making an assumption that okay, let us say in case we are doing a trade, market will go down. So if market goes down, so as a intelligent trader, what I will do, I will buy a put. And I'll say I do not want to put more than 100 rupees on risk. 100 into 50 means 5,000 rupees. So let me buy a put, and market will go down. I will make money. Now, whenever we are buying, obviously we all know, as you have rightly answered also, that decay will work against the buyer. So if market goes down, chances of profit are very, very bright. Why I'm saying chances of profit are bright? Because if market needs to go down, it needs to go down within few days. Otherwise, if it goes down after 20 days, then also it may so happen that okay, we have purchased a put, market has gone down and still we are not making profit, right? But chances are good that okay, it will make the trade will make money. If market stays there only, as we all know, the decay effect will cause uh, a loss for the trader. And if market goes up, that means our assumption has totally gone wrong. And then obviously there will be a loss. And in any case, in this case, we know that our loss is fixed as 5,000 rupees or 100 rupees. Right. So now what to do in case our assumption goes wrong? That is one. And what to do in case market stays there? Again, my assumption is going wrong. Market is not going down. So in any case, when market is not going down, that means my assumption has gone wrong. So I need to do something. So let's say market stays there or goes up. Both the things will say that okay, whatever we predicted, that has gone wrong, and now we are losing money. So what we need to do, maybe need to sell one lower strike price put covering around 50 rupees. This put we have purchased for 100 rupees, maybe 3-4 strikes below we can sell a put at around 50 rupees. So what will happen now, I have given market 100 rupees, I have taken back 50 rupees from the market. Now if my assumption is going wrong, that okay, market is not bearish, market is becoming bullish, in that case my maximum loss now gets reduced to what? Can anybody help me? What will be my maximum loss now? If I'm able to sell one lower strike put at 50 rupees, I purchased a put at 100 rupees. What will be my maximum loss in this case now? So 100 I've given to the market and 50 I've taken back from the market. Whatever happens to the market, my maximum loss will be 50. Thanks, Mr. Ali, right? So 50 into the loss is 2500. Now I have converted the trade into a bear put spread, right? I'm converting the trade into bear put spread. Now somebody can ask me that okay, your assumption has gone wrong. Now market will go up, so you will lose 50. What happens if now market starts falling? If now also market starts falling, there is no issue at all. We will still be making money because it's a bear put spread. Falling markets are good for bearish trades, right? So then also there is no problem. So market goes down after that because market is market. It can go up, it can go down anytime. So market is market. If it goes down after that also, then also there is a social profit. If market keeps on going up or if market stays there only, then possible loss is reduced by 50%, and still we have time, right? Still we have time. We would not like to lose in this trade. Uh, I'll show you how even this trade will be profitable, right? Again we say that market is not falling, market is going up, or market is staying there only, right? We can bring the sold put up, or we can add another put, not only to cover this initial 100 rupees, but to get more than that. We can sell another put of 40 rupees. We can sell another two puts of 40 rupees, which are at a lower strike than this. In that case, what will happen? Ultimately, we may collect, let us say, 130 rupees. And if market keeps on moving up, in any case, I'm making 100 minus whatever credit I have received. That will be my profit. Right? A very, very simple adjustment. But then why we are not able to do that, I'll show you that also. Right? It will get converted into a ratio spread with credit. Even if market falls after this, still there will be a huge range available within which we will be profitable. So what has happened is, we have started a simple trade, assuming market will go down. We purchased a put. If market goes down, purchased put gives me a profit. I will immediately book my profit. If market doesn't go down, I will, let us say, wait for 3-4 days. Market stays there only, I will add one sold put. If market keeps on going, if market goes down as per my calculations, again it will be a profitable trade. I will book profit as early as possible. But in case my assumptions are again going wrong, I will sell another put. I will sell maybe two more puts to cover that 100 rupees. If I am able to get 120, 130 or 140, 50 rupees, anything above 100 rupees which I am able to take is going to give me profit only. Right? A very, very simple trade. Now you can say that, okay, I have sold three puts and I've got only 30 rupees extra. Is it worth selling three puts and taking only 30, 40 rupees into the profit? Is this worth? We say, okay, let us try another thing. Now, if market goes up from here, there is no issue at all, right? What Mr. PA is saying, does TOS has any spreadsheet to manage position sizing, initial margin, additional margin, to plan for adjustments? Oh, I wish we would have had that, but we are not having as of now any spreadsheet, right? But I think you can always use Oxtra. Oxtra gives you all those things. What is the initial margin required? And generally, we do not do adjustments where a lot of additional margin is required. Hardly any additional margins are required, right? For super smart adjustment, would you please guide on initial and additional margin to keep aside for adjustment at the time of trade setup? We always give you what is the margin required, and most of the time, I would say 90% of the time, we do not give any adjustment. We do not do any adjustments where any significant additional margin is required. If we are creating extra spread, maybe 15 to 20,000 rupees are required, right? So don't worry about that. And in any case, we are keeping positions so light that, okay, again, I would like to say, if you're observing super smart hedge trades or smart hedge trades, you should divide your capital into four parts, and we at any given point in time do not keep more than four trades open. So you divide your capital into four parts and deploy one-fourth of your capital into each part. If there are three trades, obviously you're always having decent amount of margin available with you, right? Today, Bank Nifty, after downtrend, it goes up, but in option strike ATMs was not as much as Bank Nifty future. What is the reason behind? I couldn't get the question, Mr. Radhakrishnan. You're saying Bank Nifty after downtrend it goes up, but in option strike ATMs was not as much as Bank Nifty future. What we want to say that ATM strike price premium should be same as future premium? I think if that is the question, obviously that is not the case. Future premiums are much less compared to ATM strike premiums, right? ATM strike premium, and we are on the first day of the month or first day of the series, even if you're talking about weekly options. So obviously, uh, option premiums will be much higher compared to future premiums, right? So in this case, if market goes up, no issue at all. We still be making money only, right? Now this adjustments looks very, very simple, but not easy. Why? Because we get into multiple complex positions. Even in our own trades, we get into multiple complex positions, and then it becomes very difficult to bring money for selling extra put. If I purchased a call for 5,000 rupees and I want to cover that 5,000 rupees by selling one extra put, I require maybe 20,000 rupees. But if I'm required to sell two extra puts, maybe I'll require 70, 80,000 rupees. If I want to sell three extra puts, I require 1.5 lakh rupees, and that is the problem, that all the money management goes for a loss, and ultimately you're not able to do this kind of a simple trade. And then some whipsaw movements of the market make it more difficult to adjust. You try to adjust and market goes down, and then we are afraid that okay, I may not be selling more puts, right? And in case market suddenly makes a big gap down, then also there will be a issue. And here again, money management becomes really difficult if you have not planned things in advance. So I'm going to show you that okay, what kind of money you should be putting if you want to do this kind of trade, what kind of margin I should be allocating for one single trade of buying a call or buying a put, so that whatever happens to the market, we are not going to lose money. Any possibility should be that okay, it should be a profit only, or at the worst scenario should be the break even, right? What Rajiv is saying, thanks to the adjustment strategies taught at the option school, I converted a sold 16,600 call into a spread, and now the setup is in profit, although this trade was just for testing the case. That's the main thing. If you're able to adjust the things at the right time, I think there is no scenario where we are going to lose money. So what I'm saying, we need to plan in advance that how we are going to manage the margin required. Again, you cannot go that okay, I have only 50,000 rupees, I have purchased a call, I was bullish, but market is now not going up, market is going down, I do not have any money to sell a call. Then in that case, even if you know these things, even if you have good understanding of this adjustment, then also there will be no profit, right? Because you are not able to execute your understanding into the markets, because margin management is not proper, right? Let me show you a simple example here, what kind of margin we should keep. Let us say we create a simple position, we purchase a call as well as a put, right? In the beginning of the month, maybe for current month, maybe for next month, let us just buy a call and buy a put, buy both the things. What will happen if market moves up? We will book profit in the call, and we will adjust the put side, and we will cover whatever money is left on the put side. If market goes down, we will book profit in the put, and we will be able to cover whatever money we have given on the call side by selling some calls, right? So again, I am saying, as a thumb rule, keep margin for 3 sells against 1 buy. Am I making some sense with this? When I'm saying keep margin for 3 sells against 1 buy, so for one buying, how much margin we should be having in our account? Can anybody tell me? So the margin required will be around 1.5 lakh. If I give you a simple example on Opstra also, suppose I'm saying I'm bearish. I'm just saying I'm bearish. So what I have done, I have purchased a 16,300 put, which is around 100 rupees, or which is around 97 rupees. Now, in case market doesn't become bearish, or market becomes mildly bearish and stays there only, I know I need to cover this 97 rupees. And I'm giving myself a leverage that okay, for covering this 97 rupees, even if I'm required to sell 3 puts, I will sell 3 puts. So as of now, even if I'm selling a 16,000 put, which is available at 52 rupees, I'm not going to sell it right now and create this kind of a trade. No, I'm saying let me wait. If my view is bearish, let me see if this 97 rupees purchase put can give me profit. But in case it is not going to give me profit, I will sell some puts which can go up to 1, 2, or 3, and I will get a credit of more than 97 rupees from the market. So ultimately, even if the market is going up, even if my view is wrong, then also I'm going to make profit on it, right? For that, if I'm buying this put in 100 rupees, I need only 5,000 rupees, right? But at a later stage, if I need to sell 1 or 2 or 3 puts, I must be ready with this kind of a margin for every one purchase. Obviously, if I'm buying a call also, the money required will be almost similar. So buy a call, buy a put, and keep 1,50,000 rupees for each long strangle, I would say. If you're buying a call worth 100 rupees, buying a put worth 100 rupees, and you're keeping 1,50,000 rupees, so that in case required from one of the sides, you need to cover this money, and other side obviously then will be profitable. So market will make a move in one direction, right? So the worst scenario will be in case market doesn't move at all and both the positions decay to zero. In that case, also by selling few calls or few puts, we will be able to cover this money. But since markets are swinging, since premiums, not high premiums are available, it makes sense that okay, if I have a view, if I have bullish view, just buy a call and sit. If that view goes correct, you will always make money. Otherwise, you can always cover the money by selling few calls. If I have a bearish view, buy a put. If that view goes correct, you will make money. If that view doesn't go correct, then I have funds to sell more puts which are of lower strike to cover that money also. If I do not have a view, if you're somebody like me who do not have much of a view that whether it will go up or go down, or maybe I can do both. I can buy both, but I will be required to sell only either calls or either puts. I do not require 3 lakh rupees. Either the market will go up, I will be required to salvage my money from the put side, or the market will go down and put will give me profit. I will need to salvage my money on the call side. So ultimately, only one side I need to sell one or two or three calls or puts, right? So what Mr. PA is saying, 1st September, any major changes in margin of cash versus quoted for position trades, percentage of cash margin needed as what will be. I don't think there is any change for cash versus pledge margin. I think if there is any change, that would be for intraday traders. You need not worry, Mr. Prashant, for that. Mr. Voice of Ramesh says, sir, today I entered with bear call spread in Bank Nifty, exited with a loss. So if it was a sort of a intraday trade and you have done a bearish and market has gone up, obviously there will be a loss. So your view has gone wrong and it has to be beared. But then there would have been many ways to adjust that. Hi, Mr. Kamal, how are you? Okay, what Dr. Bhaskar from Europe is saying, holds sold odd lot 25 into 17,000 December 21 at 2017. Is it a put or a call? Cannot be scared of due to SEBI stupidity. Okay, there is one. Okay, 20. So what has happened is earlier the lot size was 75. Now they have converted the lot size into 50. And I'm really surprised to see that they are saying that December, whatever 25 extra are there, they will lie like that. And only on December expiry, whatever is the price, at that price you will get that money. That is real stupidity. That should not have been the case. They should have settled it right now, that 25 units, but they are not settling it. You see, sometimes you have to bear with these things, Dr. Bhaskar. You cannot do anything. Good evening, Mr. Manoj. How are you? Okay, now plan to buy two full lots to convert into purchase call and ring fence the possible loss and market continue to rise. Cannot think of anything, any idea. No, what you said you have sold um, 25 units. You're 25 units of 17,000 call are stuck. So just go ahead and sell one 17,500 call. All your money is out, Dr. Bhaskar. Just simply sell one 17,500 call of December. So you will get money for 50 units rather than for 25 units, right? Limited opportunities for me in Netherlands to be hands-on training. Yeah, that would be difficult. There would be a decent time gap also. But again, my request to all of you, let us try to keep things as simple as possible. What happens is because of these trading strategies, because of a lot of complex strategies. Now, what happens in the strategies is they protect us like anything. At times when market makes a wild swing here and there, then strategies are good. But then ultimately, can I convert that? Okay, what is my strategy? Ultimately, whether a net result of my strategy is a call buy or a put buy or a call sell or a put sell, then accordingly I can add on the positions. And for each strategy, it's always better to keep some money depending upon what is the kind of strategy, what is the kind of range it has given. Here I'm talking about a very simple trade that just because markets are swinging one day at a higher level, one day at a lower level, so better to buy both the things. Wherever the opportunity to book profit is there, book profit, and you have all the know-how, all the money available with you to cover any amount of losses from the other side. So ultimately, we'll be in decent profit, right? Top three strategies you would recommend during low VIX environment at present. Again, in low VIX environment, always calendar spreads and diagonal spreads are great strategies. What I am recommending is something based on how the market behaves. right? Now, only problem with calendar spread strategies is that okay, if the swing is high, it is not able to take care. So you need to know the adjustment, how to convert your calendar spread into a double calendar spread, or if required, into a triple calendar spread. So your amount of investment keeps on increasing. But yes, they are very good strategies as long as the swing is within a limit. What I am giving you right now is sort of a, you can say, if you keep it 1:1, it's sort of a reverse iron condor, wherein you are buying one call, buying one put, you're selling one call, selling one put, and if required you're selling another call, selling a third call, getting converted into a ratio spread. So uh, I don't think I can name it as a double ratio spread or something like that, but as long as you keep at 1:1, it will be a reverse iron condor. But as soon as you book profit on one of the side, the other side you sell an extra call or extra put, it becomes a ratio spread on that side. This strategy also should work well. We have done some groundwork yesterday, but yes, for this strategy to work, the market needs to be pretty much swinging, right? So if market is swinging, Mr. Prashant, if it's making 150 points every day, then obviously this strategy will work fantastically well. Nothing to worry. Okay, anybody willing to join our membership? We have 4 memberships. You can see some exclusive videos in gold membership. You can connect to us on WhatsApp for diamond memberships. You can see some of our trades in smart hedges, and you can uh, see our trades in super smart hedges. Plus, you get a 40% discount in our single strategy workshops. And we have 3 recorded workshops: mastering iron condor, short strangle plus covered call, butterfly or butterfly in Nifty and Bank Nifty. So I'll say ultimately whether VIX is low, whether VIX is high. As far as iron condors are concerned, yes, VIX needs to be decent. We need to have a VIX of more than 18, 19, 20. Then iron condors work better than others. But you can try a modified version in low VIX also. Butterfly works even in low wicks. Although for butterfly also higher the wicks better it is, but even in low wicks the advantage is that okay, losses are very limited, and there is a way that okay, we can get out of that butterfly even if uh, market doesn't remain in that range. But ultimately, I will say ultimately in any of the strategies there is one supporting strategy which is known as short strangle. Any strategy, let us say you are losing 40 rupees, you create a short strangle of 20 rupees on both the sides, very far away, and you are able to cover any of your loss in any of the strategy. So short strangle is one evergreen strategy, whether it's a low wicks, a mid wicks, or a very high wicks. Ultimately, if a trader knows how to sail through a short strangle, he can sail through any other situation also, right? Your workshop, Rajivji says, have been a great help in understanding the nature of market swings and adjusting the trades properly. Thanks for all that. So nice of you, Rajivji. You see, main aim of the workshop is not that okay, we have some holy grail with us and we are going to give you that holy grail, and then after that every time you are a winner in the market. Main aim of the workshop is give you that kind of a mindset that okay, I am into trading, I am doing a business, and it's not possible for anybody to judge the direction of the market every time. So even without judging the direction of the market, with my numbers, with my mathematics, with my strategies, with my adjustment mindset, can I sail through these markets and generate a decent return on annual basis? You may not be generating a great return every week or every month, but if on annual basis you are able to generate something like 30% to 40% to 50% in every kind of environment, then it sounds like a good business, right? So we always say that option trading needs to be treated as a business rather than a gambling place. So when you are just trying that okay, let me buy a call of 100 rupees, if it becomes 400 rupees I will be very happy, otherwise okay, let me lose 500 rupees into 55,000, then this is a gambling mindset. So many times many people come to our workshop, they need to unlearn a lot of things before they start learning what we are teaching in the workshop. So Rajiv, I think you have comprehended the things uh, extremely beautifully, and I really feel so happy for you the way you are now applying all the learnings in the actual markets also. Mr. Girja Pujari says, hi sir, how long can we stay in such long position in a monthly options? You see, if you have the strength of selling few more options, if you have that kind of money, you can stay in the positions even uh, till the beginning of the fourth week, right? So if you see at the fourth week, ATM positions still have 200 rupees in them. right? So not much damage is going to happen. But as soon as you get your desired 3-4% profit, you can always quit the position and then create this position for the second month. I do not mind if I create these buyings in the second month and I keep on selling current month positions and then keep on selling second month positions also to recover everything, because possibility of markets making a big move in 2 months is much higher compared to possibility of making a move in 1 week or 1 month. Only problem is by seeing a lot of social media M2Ms, we are always worried that okay, every day we should make money, which becomes a difficult proposition in any kind of markets or any kind of trades also, right? What Mr. Nalin Sharma says, my trading journey started after your workshop last year in September. It has been a really good year post that. All thanks to you. So nice of you, Mr. Nalin, and happy that okay, you're able to use the learnings of the workshop in any kind of market. See, markets will keep on changing its structure. Whatever was working maybe in 2016-17 is not working in 2020-2021. Whatever is working now may not be working in 2023. But if you have understood the concept that okay, this is simply something, how much money I'm giving to the market, how much money I'm taking from the market, and I'm able to manage my margins, I'm able to manage my risk, whatever is the structure of the market, whatever SEBI rules changes, whatever happens, I think there should not be much of a problem. There will be little bit of adjustment here and there in the trades, but ultimately you are able to sail through any kind of market. So it's not that okay, you join a workshop and then whatever strategy is shown, that should work for next 10 years. It's not possible, right? But that mindset of adjustment which we try to give all our participants in the workshop should be with you. Those brain cells are with you. So whatever little bit changes or drastic changes happens in any kind of the environment of the market, or there is a low VIX environment, there is a high VIX environment, some rules change, some margin requirements change, all these things you are able to take in your stride and adjust accordingly. That means then you have become a complete trader who knows how to sail through these kind of different situations. There cannot be a ready reckoner for everything, right? Hope you understand these things. So we have a 2 days workshop on 4th and 5th of September, where again we will be trying to give you a lot of mindset on how to adjust trades. Whatever is the trade, ultimately trade can be converted into one single position, and what can be the adjustments, what is the money management, how we have done back testing of trades, even when markets have given very, very wide swings. All those things will be covered in this 2 days workshop, which is happening on 4th and 5th of September. Anybody willing to join can contact us on the number given on the WhatsApp. Right. So how to defend sold calls, Mr. Vinod says. So again, we have done some videos how to protect your bleeding calls. Please go through those videos, and in case you have any questions, feel free to write to us in the comment section. Do join us on Twitter. Our handle is @the option school. Link is given in the description also. For any queries, feel free to connect to us on these numbers, on this email ID. Please click on the like button. Your like buttons are always very precious for us. And thanks, sir, for unveiling the buying strategy. You can say this is a buying strategy. Definitely in this kind of market, VIX is low, swings are high, so buying strategy is great. But then we must know what to do in case that buying strategy is not working in our direction, right? Share this video to somebody whom you think it will be useful. Write your comments, questions, any suggestions, any feedback in the comment section. We'll be more than happy to reply to your comments. And if you have not subscribed to the channel, please go ahead and click on the subscribe button. So today is Friday, Saturday, Sunday, weekend, Monday. Let's be ready. Let's see. I think at some point in time, SGX Nifty was showing 164 points plus. I don't know what it is showing right now, and depending upon how markets react to whatever is happening on Fed chairman's speech, we may expect a very volatile session on Monday, right? Monday markets are open. Many of you have asked me a question whether there is a Janmashtami holiday on Monday. No, there is no holiday on Monday in the markets, right? So we have to be present there and we have to celebrate our festival in whatever time in between is available. But yes, we prepared for some volatile action on the markets on Monday, and after that we see that okay, there are hardly any events. So markets once will make some move here and there, and after that it should definitely settle down. So till then, for 2 days, enjoy the holidays, relax. No need to keep on saying what is happening to SGS or everything. Just relax. Whatever we can do at 9:15 only. Before that, we cannot do anything. Right? So enjoy your great weekend. Wish you all the best for the weekend also. Thanks for joining. See you all on Monday morning in pre-market report at 8:30 a.m. Thank you.